Hi, everybody. This is Tim from Trading Strategy Guides. I always want to say good morning because it's 8 a.m. here in North Texas, but I know it's afternoon if you're across the pond, and evening if you're across the other pond. Today, I want to look at the double death cross trading strategy. I love that name. It's just so gothic. But first, I want to make sure that you guys can hear me and see the title slide. So if you wouldn't mind putting something in the chat, if you can hear me and see the title slide. Coffee is hot and fresh and it's plentiful. So even if you can't hear me, I'll be good. While I'm waiting for your responses, let me say this. If you're watching the recording of this live webinar, you can speed it up by clicking on the gear icon in the lower right and selecting a faster speed. If you're watching live, well, then you get to answer questions. I mean, you get to ask questions. I get to answer them. So that's kind of your trade-off. Thank you, Azim and Olobanjo. Please forgive me if I just massacred your name. Stay around to the end of the webinar here, and I'll be sharing a brand new trading maxim, number 47. Thank you, German. Also, don't forget to click the subscribe button and click the bell for notifications. So we'll let you know as soon as a new video appears, which theoretically is Monday and Friday for analysis videos, and Wednesday morning for live webinars. Okay, I've got a couple of trade updates to bring you this morning. First thing is this Litecoin. Litecoin messed with me all weekend, but you know, I bought it on Friday because this was a close. Technically, it was a close above the ascending triangle. But I closed it on Sunday because it closed back in the ascending triangle. So consequently, I missed Monday's move up. And if you guys got it, that's awesome. I'll give you suggestions on managing this. I did get in this yesterday when this pulled back. Was this yesterday or the day before? Yesterday, I guess, when it pulled back to the 1 ATR level here. So I'm in it here. It hit my 1 ATR target yesterday, around 2-ish. My first target was 136.27. If you're still in this, your target was 126.33. I have since moved my stop up to break even. I took half off. So I've got half position at break even right now. If you guys still have the position from Friday, it's probably a good time to move your stop up where my stop is, 126.33. So that'll lock in about $9 for you. So then you can follow along with my stop. Unless, of course, you want to do something else. You don't have to do it exactly as I do. I promise I won't be mad. Okay, Ethereum, I closed this half-size position. This was my original range support level. And I took this trade, I believe that was Sunday night, half size because it was wimpy volume. It was like 78% volume. I closed it Monday. I discussed that on Monday's video. And I moved this range support down. The new range support I've got at 229.28. and the range resistance at 274. I'm looking for a close above the range to buy or a close below the range to sell. So I'm out of my half position for about a 1% loss, I think. Well, it was a half size per position, so it's a 0.5% loss up here. I risked 2% on a full size trade. So I'm looking for a close below or a close above this range to take this. I discussed this on Monday in the video. I'll link the video below in case you missed it, so you can check it out. Disney has been moving nicely. Last couple of days it's dropped though. My current stop on the second half, this was a half size trade on this break of this ascending wedge. The volume on the break was less than average. So this was a half size trade here. I got in right on the close of this candle right here on June 3rd. Moved up nicely, hit my first target right here where my stop currently is. And I moved this stop up. I believe I mentioned Monday that I moved the stop up to 134.61. So far it's holding. Could get hit today though, because this is a really bearish candle. So we'll see. I'm good with this. $2.14 profit. Again, it was a half size trade, so 0.67% gain if I get stopped out right here. I'm good with that. You know, we take some small gains, we take some small losses, but we get the occasional really huge win, and that's where we make the big bucks, as they say. Again, I want to say though, you don't have to manage your trades the way I'm managing them. Okay, there are lots of ways to do it. I don't have a corner on the market or anything. I'm just showing you how I handle these things. As my son would say, you do you, boo. So anyway, let me check out the questions. Sanjay, thanks. I appreciate that. I hope to be getting a new microphone soon. I want to get a higher quality mic because I think this mic makes me sound like a mouse. I don't like my voice anyway, so it doesn't matter, right? The channel is Trading Strategy Guides. You'll be able to see the links I'll put below the video. It may take me an hour or so after the video gets posted before I get all the links below, so I'll be patient on that. Best broker to use, Hardy. I use several brokers depending on what I'm doing. I use Awanda. I'm in the U.S., so I'm kind of constrained to U.S. rules if I use a U.S. broker, but I use Awanda for that. And I also like Trader's Way. And if you go to, if you email info@tradingstrategyguides.com, they can give you the link to get you a good deal at Trader's Way. So thanks, Casey or Ben. I guess you're talking about the Disney. Yeah, that's worked out fairly well, hasn't it? I don't think, Fiona, I don't think Ethereum is on MT4. I use Binance for my crypto trades. I have some in Coinbase, and then I have a wallet that I keep my long-term cryptos that I hold long-term. And I have some of those. Some of them are negative and some of them are positive, but it's, you know, it's like holding US dollars or whatever. Oh, Litecoin, right. Yeah, that Litecoin has turned out fairly well, hasn't it? I'm happy. I'm even happy with my late position here after closing on Sunday night. Okay, let's talk about the double death cross strategy. I know I mentioned I really like that name, didn't I? Okay, for starters, the death cross is simply uh, when the 50-day moving average crosses down over the 200-day moving average. If you listen to CNBC or MSNBC or any of the other news services, you know that they take the 200-day moving average very seriously. So when the 50-day moving average drops below the 200-day moving average, it's known as the death cross. Um, the opposite, of course, is when the 50-day moving average crosses above the 200-day, and that's known as the golden cross. We call our strategy the double death cross instead of the double golden cross because it sounds cooler. I don't know, really. That's not the reason, I'm sure. But we're going to be looking at the strategy in both directions, but for the purposes of our examples, we're going to be looking at the short or the sell version. So anyway, you can see that when the 50-day moving average crossed over the 200-day moving average, the market dropped like a rock. Now, I'm sure this is as much psychological as anything else. You know, the media trains the public to do certain things. And in this case, the public is trained to think, oh, I got to get out. I got to sell when the 50-day goes below the 200 or when the price goes below the 200-day moving average. So one thing you'll notice uh, on this particular chart is that the price action is right near the moving averages when the moving averages cross over. That's an important part of our strategy, and that's what you need to look for to take advantage of this. So in this case right here, you can see the death crossover happened here, but price was way down here when that happened. And then what did it do? It just went sideways, okay? Because um, uh, the moving averages are kind of like rubber bands, okay? When price moves away from them, they'll snap back together at some point, either by price moving back to the average or the average moving down toward the price. And I mean, that's just kind of by definition, because if you're looking at a 50-day moving average, then you know that if price just stays down here by the 50th day, the average is going to be down there where price is. So, you know, if the price is a long ways away from the moving average, it's not going to stay there for very long. So now that you know what the death cross is about, let's talk about the strategy. Because price is not always near the moving averages when they cross, we're going to add an element to this strategy to give us a few more trading opportunities. Okay. So we're going to add the 100-day moving average to the mix, the yellow right here. Okay. Of course, use whatever colors make you happy. Just remember what they are. It's a real time saver if you always use the same colors for certain moving averages. Okay, so here's the strategy for a sell trade. Step one, wait for the 50-day EMA to cross below the 100-day EMA. The two moving averages also need to converge with the price action. Okay, so we're looking for the 50-day, which is the blue one, to cross below the 100-day EMA, while the price action is right near the cross. Okay, in this case, it's right on top of it. It doesn't have to be exactly right on top of it, but it needs to be near it. And, you know, you have to have a definition of what's near it. When it comes to looking at price action and price moves, you guys who've been around a while know that I like to use the average true range to get an idea of whether price is close or far or whatever. So the average true range And I use typically a 13 or a 14 period average true range. And what that tells you is the average length of the last 13 or 14 candles. So from the high to the low, and then average those lengths. So that is going to be relative to whatever market you're trading. In this case, the Great British Pound versus the US dollar. In the case of the prior chart, it was the S&P 500. But it will adjust for your time frame. It will adjust for whatever instrument you're trading or whatever. So that's the reason why I like the ATR. I use it for lots of things, including targeting, stop losses, and determining if the market is close enough to consider taking trade here. So in this case, I would want to make sure that the price action was at least within one ATR of the moving averages when they cross over. Okay, so back test this yourself. This is a great strategy here, but you've got to have confidence in this strategy. Just don't take my word for it. You need to test it. You need to back test it and forward test it so you have confidence. And you do that on any strategy that you're going to use, so that these strategies are not 100%. They don't work every single time. So you've got to have confidence that the strategy works, so that if you go through a string of losses, you're not going to just be changing your strategy every, 2 losses because you took losses on your trade. Okay, that's what we call anecdotal evidence, and anecdotal evidence is not real data, test data. So, okay, this crossing, the 50 crossing over the 100 is likely to be a much earlier signal than the 50 crossing over the 200. So, like I say, the key is to make sure the price action is near here. So we're going to reduce the risk of this strategy and go in with 2 positions. We're going to scale into it, in other words. Okay. So the idea here is, when you get the crossover, 50 crossing down over the 100, and price closes below both those moving averages. So that would be this candle right here. Crossover happened right here. This candle right here closed below the 2. That's your first position. Okay, sell half your position right there. Okay. If price was already below both moving averages when the crossover occurs, then sell on that candle close. In other words, you will sell on the first candle close where both the following criteria have been met. Number 1, the 50-day moving average is below the 100-day moving average. And number 2, that the candle close is below both moving averages. Okay. So this is the first candle that meets that criteria in this case. So you sell your half size position right here. Okay. Your next sell, your next position is when price closes below the 200 period moving average. Tony, these are exponential moving averages. They can be SMA, actually. Really, the difference between them is that the EMA responds a little more quickly to recent candles. Okay, the MAs are typically on the close of the candle. The exponential moving average weights the more recent closes higher than they rate the earlier closes. So the EMA will react more quickly, but the EMA will also likely give you more false signals. Okay, the MA will be smoother. So I mean, the SMA will be smoother. Okay. So you can actually use either, and I would experiment with both and figure out which one works best in whatever time frame and instrument that you happen to be trading. Okay, so your second position sell is right here on the close below the 200 period moving average. You guys that have been around with me a few times, you know I like to wait for candle closes. Uh, it helps you stay out of head fake situations. Now, I realize that if you just take a break as soon as price breaks below this, you're probably going to get a better price. But to me, the confirmation is the close below. Up here, you can see that price broke the moving averages, but didn't close below until here. So yes, you would have gotten a better price here, but this is a confirmation. And in the case like this right here, where it broke below and then closed way back up here on the next candle, you know, it's likely that something in here would have hit the stop loss if you had taken the trade on just a break of the moving averages. But again, I say test it. You know, if the break produces more successful trades, even if you take a few extra losses on it, then it might be worthwhile. That's the reason why we test strategies. Okay, and that's also the reason why there are as many different successful strategies as there are successful traders, because it's personal. It's we trade in a style that fits our personalities, and you know that sounded so bogus to me when I started trading, and I thought often it was just the trainer, you know, um, trying to make it sound mysterious. It's not about that at all. It's about my level of ability to focus on the charts, my level of confidence in pulling the trigger. Um, all of these things are factors in your success as a trader. Your ability to maintain discipline and pull the trigger when the rules demand it, and stand aside. Your ability to stand aside when the rules demand it. These are all factors that you have to take into account when you're picking a strategy that works for you. So, you know what? The only way to do that is to try a lot of different strategies. I used to work with a trader who was a beast about trading 1 minute charts and taking trade after trade after trade and shutting them down. He never used actual hard stop losses because he was trading too fast. He didn't have time to set stop losses and targets. He just opened and closed trades when they did what he expected them to do, or when they didn't do it what he expected them to do. I couldn't do that. I couldn't focus. I was missing trades. If things didn't happen for a few minutes, I was my mind was wandering somewhere else, and that just didn't work for me. When I did try it, and I did successfully try it, I made a lot of money, but I was so burned out inside of 2 weeks of living my life that way that I just couldn't do it. This man could watch the charts 18 hours a day, sleep 4 hours, and then eat for 2 hours. So it was just, he was just a beast, and he's a great trader. But I just could not. I thought, wow, if I could copy what he does, I could be a gazillionaire too. But no, I just couldn't do it. So I had to find other ways, other things that worked for me. So I'm off that soapbox now. Okay, the next step, after you've got your positions in, you need to put your stop on your first position. put your stop loss above the moving averages here. Okay, you know that if you're going to close, um, if you want to, you can wait for a close above the moving averages to get out of the trade, because as you can see here, well, in this case it didn't happen, but price sometimes may push back up above there and then push on back down. So people clear stops out, and you can expect stops to be on the other side of moving averages, on the other side of swing highs and swing lows and so on. So put your stop above the moving averages. You need to make sure that your stop is of decent size. This is a daily chart we're looking at. If you're looking at daily candles, you need your stop to be, quite a bit above it. And that's the reason why I use the ATR to determine what my stops are. I would, and I've found this to be extremely successful. I use 1.5 ATRs for my stops. I do that all the time. So in this case, I don't know what the ATR is here, but this is the daily British pound. So I imagine the ATR is somewhere around 100 or 150 pips. So 1.5 times that, or maybe 175 or 200 pips, and put my stop up there. And then my first target will be 1 ATR. So yes, I use a smaller target than I use stop loss, but I have a higher win rate because of that. So when it hits my first target, I take half off the trade and then move my stop to break even at that point. So if you want some more details about that, check out my trade management webinar that I did a few weeks ago. I will link that below this video later on. So in any case, put a stop loss in on your first sell. When it hits the second position, put your stop loss in. The problem here is going to be managing your risk on this trade. Now, I use a 2% risk on all my trades. So this whole position, I should not risk over 2%. That's one of my trading rules. Okay. So calculating the risk on this is difficult because you're waiting for a close below the moving average. And you know where this moving average is right now. But when you enter this first position, you don't know how far below this moving average this is going to go. Okay. So it's possible what you need to do is use 2 different sizes here and just risk 1% on your first trade and then risk 1% on your second trade. So your first position will be 1% risk based on wherever you decide to put your stop loss up here. When you put your second position in, calculate 1% risk on it based on your stop loss being up here above the 50 and the 100 period moving average. Okay. So just be sure that whatever you do, you maintain your risk parameters. That's the most important thing. You can't put a lot of size, a lot of risk on a single trade. You're never going to be a successful trader if you overload your trades. Okay. It looks really good until you take a couple of losses and you realize that, I've lost 10% of my account. No, you lose your account, you're done trading. If you get your account down to a certain point, you're not going to be able to trade anymore. So the whole concept here is live to trade another day, right? Okay, let's talk about taking profit on this strategy. Now, again, I say the strategy I use to take profit is I will take half of my profit off once the trade moves 1 ATR. I would use something like that here. Probably what I would do is figure out where the average, where my average price is on these two positions, and 1 ATR from that, I would take half of the trade off, half of each of them, or however. The truth is, I haven't really contemplated it because I rarely go in with two positions here, and I handle each of those situations separately. But for me, I would let the second half run, and I would use this strategy to close the second half. So I would take half off, put my stop at break even on the second half, and then I would let it do this. As soon as the 50 period moving average crosses below the 200, and this is a mistake, by the way. I lifted these images from the blog, and this is a mistake on the blog. It is actually, it should say the 50 MA crosses below the 200 MA right here. At that point, draw a vertical line, find the candle, and I would put a horizontal line at the top of this candle. That would be the point at which I would close the trade and take profit. So when price, I'd allow price to continue to push on down. At some point, you know, you might even want to consider moving the stop, your stop below that. But initially, that's a great place to consider taking profit. Okay. I'm going to link this blog below the video so that you can go and check out the details on it right there. Okay, this slide shows the whole process for the double golden cross strategy, which is just simply the opposite of what we were just talking about. So basically, you look for the 50 period moving average to cross above the 100 and the price action to close above. So that would be this candle right here, this close right here, or this close right here. I guess it's this one right here. You'll notice that price was already above both moving averages, so that's okay. Price had just pushed through, and then the crossover occurred. So just buy on that close, buy the second position up here on the close above the 200 moving averages. When the 50 crosses above the 200, that's your signal. Take your profit right there on that. Okay. Anybody have any questions? Let's see. Q&A. Q&A time. Let me make sure that everybody's good. Okay, thanks, Casey, Ben, whoever, my little assistant. That po.tradersway.com login link up there is the link for Traders Way. Traders Way is awesome, you guys. This is outside the U.S. and I'm always looking for good brokers outside the U.S. because, let's face it, these U.S. trading rules are so stifling. So if you're a U.S. citizen and you want to get a broker that will accept you and doesn't have the stifling trading rules, there's nothing wrong with going to Traders Way. I have never had any trouble getting my money out or putting money in or anything with Traders Way. So I recommend that. Now, I never recommend putting all your money at one broker. Never, never, never. And even a US broker. Now, I have a lot of confidence in Owanda. I've traded with Owanda since I think 2006 or 7. I have a lot of confidence in them, but I still don't put all my money there because even the big brokers, US brokers, regulated US brokers can fail. I ended up taking a loss when I can't remember which broker now it was, but a broker failed a few years ago and I had money there and I ended up with about 10% of my money out of that account. So, um, Ishar, again, apologies if I don't pronounce your name right. You can use either the EMA or the SMA, and I would experiment with both. I would probably use the EMA because they respond more quickly and you might get more signals. However, the SMA may give you more reliable signals. So test it and be confident yourself in what's working and what isn't. And if you want to back test, all you have to do is just put those moving averages on your chart and just go backwards and see where your entries would be and actually write them down. Make a log of where your entries would be, at what price, where you would be taking profit. Just run the trade as if you were doing it live, and just do that every single time you get the setup in front of you, and see how it does. See which one works better. See how many head fakes you get with one over the other, and so on. The strategy is great. You know, I would stick with the 200 EMA or the 200 moving average, the SMA and the EMA, because that's the one that the public looks at. Okay, and that's really what makes it the death cross moving average. But you might want to tweak the other ones. Try different ones. I am a firm believer in testing and testing and testing whatever strategy you use because it gives you confidence. Plus, it helps you understand exactly what's going on in your strategy and exactly how it works and so on, so that if it stops working for some reason, for a long period of time, you can look at it and you say, well, you know, why is this suddenly not working? And I have had really, really successful strategies that I've run for months and months and months at a time, even years at a time in a couple of cases, that just suddenly were taking a bunch of losses. And so I had to spend a lot of time identifying why this was suddenly not working. And then I was able to, in a couple of cases, I was able to identify what market conditions were not ideal for that particular strategy. And I could set the strategy aside when I saw those market conditions occurring. So use all the tools in your toolbox, and you will do well. Okay. Just know that it's not like an instantaneous thing. This is no get rich quick scheme. Trading is hard work. Okay. Oh, sure. I'd be glad to go through it. Step one, you look for the 50 period crossing down over the 100 period with price action right near it. Okay. Step two, when price action closes below the 100 and the 50, and the 50 is crossed below the 100, then you sell. Now, if the price action was already below it, that's okay. After the crossover and price action close or a candle close below the two moving averages, sell your first position. Sell your second position when you get price action close below the 200. Okay. Set your stop either just above the 50 and the 100, and when I say just above, that depends on your um, time frame and your particular instrument that you're trading. Um, you need to allow for head fakes, and sometimes head fakes can be pretty good size. Okay, and then take profit. Look for the 50 to cross below the 200. This should be 200. I forgot my little thing here. This should be the 200. Okay, draw a line at the high of the candle where the 50 crosses over the 200. And then when price gets back up there, take profit. Now, I would definitely follow stops as this goes down, because who knows, this could go down hundreds of pips more that you want to collect some profit on too. Okay. Okay, and this, of course, is the opposite. This is a double golden cross. The golden cross is just where the 50 crosses over the 200 to the upside. So this is just the opposite. As you can see, the 50 crossed over the 100 price. And this is an example that price never got on the bottom side of these two moving averages. Okay. It pushed through, but it never closed below there. So this is a good example of when the crossover occurs, price was already on this side. So on a close, you can buy, and then buy the second position on close above the 200. Okay. Any other questions? You guys ready for a brand new trading maxim? I really love these trading maxims. They help me. I hope they help you guys. A maxim is just a saying, basically, that applies. And in this case, I apply them to trading, but I apply them to my workouts, and I apply them to other things in my life. So this is a new one. It was a friend of mine said this to me yesterday, and I thought, gee, that needs to be in my trading maxims. So number 47, leave your ego at the door. The market doesn't care. I probably said this in other ways, but a friend said this to me yesterday. Thank you, Robin. I thought, yeah, that definitely needs to be in the trading maxims. So it also belongs in my workout maxims. You see, I'm like one of the oldest people in my gym. So yeah, I definitely had to park my ego at the door there. I was a power lifter in the 90s. And so I'm in a gym now where, there are 120-pound women who can outlift me. And so I had to set that aside to get myself in shape. So, this also applies to anywhere. How much better would our lives be if everyone just left their ego in the closet and went about their lives without it? I'm not talking about confidence. Confidence is a good thing. We should all have confidence in what we do. I'm talking about arrogance and ego and all those nasty things. So bringing this back around to trading, the market doesn't care about your pride or your ego. Put it on the shelf. Forget about it. And your trading is going to improve by leaps and bounds. You're not going to beat the market. The market will always win. The market is always right. Okay. These are the steps in the double death cross trading strategy. Wait for the 50-day EMA to cross below the 100-day EMA. You know, like I've said, this says EMA. You could use SMA, and that depends on how many signals you want and how many potentially false signals you want. Okay. The SMA is likely to give you fewer signals. But when I say fewer signals, the EMA is likely to give you some more false signals. So in any case, wait for the 50 to cross below the 100. The two moving averages also need to converge with the price action. Multiple entry strategy, sell the first one when price and the moving averages, the 50 moving average moves below the 100-day moving average and price closes below both of them. Sell position number 2 when we break and close below the 200-day moving average. Put your stop loss above the 50 and the 100. Step 4, the two-step process for the taking profit. Mark on your chart the high of the candle when the 50-day moving average crossed below the 200-day EMA or MA. Take profit when this high is broken. Again, I want to say I know I should have been a little more careful with my EMA, my SMA, my MA. When I say MA, I am meaning it could be either the simple moving average or the exponential moving average. And all of these could be either. I would use the same type of moving average for all three of them, but other than that, I would not worry too much about trying out both of them. Experiment, test, test, test. Okay. Ooh, I got some more questions here. Hang on. Nandawula? Ha. Again, apologies if I mess up your name. The periods are 50, 100, and 200. Ali, I use the daily charts almost exclusively. And the reason I do that is because I don't want to sit in front of the charts all day long. And typically I can look at the daily charts once a day for, 15, 20, 30 minutes. And that's it. So I trade the daily charts. That's just me. These strategies work well on the shorter term as well. Fiona, yeah, I use MT4 for my Forex trades for the most part, although not all of them. Actually, I use TradingView for my all my daily trades. No, I just lied to you. I didn't mean to lie to you. I have a strategy, a daily strategy that I use on MT4 on 28 pairs. But most of the analysis that I do, I use TradingView because I analyze everything. And TradingView allows me to analyze cryptos and stocks and indexes and commodities and everything. So that's why I like TradingView. Plus, I like TradingView for the tools. I've used MT4 for how many years? Probably 15 years. And I'm an MT4 programmer. But when it comes to actually doing analysis like I do for the trades that I do on the Monday and Friday analyses, I just like TradingView for those. So it's just a matter of personal preference. Owanda works on TradingView or MT4. Binance works on TradingView. Coinbase, TradingView. So most of the crypto trades I take on there. Obviously, MT4 is pretty much strictly for Forex. And some Forex brokers have ETFs and other instruments and metals and things that you can trade on them. But I typically trade those things over on the TradingView. Any other questions? Anyone? Bueller? Bueller? I know I just dated myself, didn't I? If you've got a day job and you want to trade, Trading Strategy Guides does this great Strike Trader Elite trade signal service. And I think they just introduced another signal strategy as well. It's very cool. You get these signals on the Telegraph application, either on your phone or on your desktop or on your tablet or any device that you want. And you get them instantaneously, and then you can enter your trades. It's a cool setup. Below the video, there will be a link to the free signals on the Telegraph app. And also, I will put a link to the video that explains the Strike Trader Elite system. Okay, so look for those. Like I say, give me an hour or so to get those up there, maybe a couple hours to get those up there. Okay, I really enjoy doing these webinars, you guys. I do the videos, and the videos are good, and I enjoy doing those, but I enjoy doing live question and answer too. So come back next week, same time, same channel. I used last week an old 60s pop culture thing. Same bat time, same bat channel. Anybody who's was in the U.S. and was a kid in the 60s, you probably recognize that one. If you don't get it, it's okay. You just have to be old like me. Anyway, come back on Wednesdays, 9 a.m. U.S. Eastern time for these webinars, and watch for my analysis videos on Monday and Friday afternoons. As always, thanks for watching, and thanks for subscribing, and thanks for kicking us over the 11,000 subscriber mark last week. I appreciate it, you guys. You guys are awesome. So if this webinar has helped you, please click the thumbs up below and have a great remainder of your week. I'll see you next time. Nandawula. Yeah, you can use them on short term. Yeah, I just personally don't because of my because I just like to trade, half an hour a day and then hang out, watch cat videos the rest of the day. Oh, I will put a link below this video. It's going to take me an hour or so to get it, so check back, and I'll get a link below this video for that as soon as possible. Okay, for the Telegram daily signals. Ben, Casey, if you're still here, maybe you could drop it into this chat. Because I don't think I have it handy here. Okay, any other questions? Okay, you guys have an awesome week, rest of your week, and I will see you next week.